Hello there. Thanks for joining me. I am Dr. Jen, and I'm so excited for you educating yourself by listening to this podcast. Welcome to My Life as a Landlord. I asked my guest today to come back to the show and share some of his innovative thoughts and projections, not only to close out 2024, but going into 2025. You may remember him from episode 70 earlier this year, but since then, he's only added to his portfolio and experiences. One of my youngest and absolutely most savvy landlords right here in Canada. Welcome back to the show, Kyle Johnson. Hi, Kyle.
Hey, Jen. How's it going today?
Pretty good. It's been a little stressful up to now, but we're here, which is good. We're recording on the boat. Starlink was doing its thing for 45 minutes searching, and I was panicking, thinking we were going to have to reschedule, but warts and all, here we are, right?
Yep.
Well, it was great to have you on the show the first time. I'm super happy to have you back on the show. And as soon as we hung up from the first recording, you said, I want to come back and do another one about doing deals in 2024. So what about doing deals in 2024?
Yeah, after our first episode there, it left me a little bit feeling like giving a whole bunch of hard things for overcoming with deals and no tools to actually get the deals done, because as much as commercial is difficult, it also gives you the economy of scale and all these other benefits to it. It's not all doom and gloom. It's actually a natural growing path to when you start working past single family and the progression.
Love it. Love it. Love it. Well, so we did talk quite a bit about some of the hardships, the pain points. We kind of went into a bit of after the fact permits. We were talking about all kinds of stuff, but I understand you've closed on additional properties and you're working on a reno. And what kind of tools do you think that we need to be ready, maybe that are the same or even different in 2024?
Well, I think probably one of the biggest things has probably been since it's about 2 years since we had the spike in rates, is when I think we've had
in the interest rates.
In the interest rates, we've had to adjust how to make deals, because the thing is once rates go up, we all know that sales, not necessarily prices right off the bat, but sales go down. And so it causes more distressed sellers. People are in a hard point, or they've just refinanced at their new rates, whatever it may be. So, I mean, that's where you start to work on contracts on terms, not as much on price. So I think that's like probably one of the biggest parts, how to like negotiate new deals now. Because if you're just going to go and take your property that you're able to buy during COVID for a commercial like 3.5% interest rate, now we're at 7% to 6.5%, and it just doesn't cash flow, and that makes it just not sell, even though arguably maybe the value is still there, but it just can't sell because someone can't come in and run it like someone that's locked in on 3%.
Right. And one of the unique things that we're seeing, because we're doing deals on both sides of the border, Canada, the most they'll do is a 5-year term. That's the most that they'll do. And so we might be locked in for that low percentage rate for up to 5 years. But in the States, once you have an interest rate locked in, it's for 30 years. There's no term. And so I think there's going to be a lot more turnover in Canada, a lot more turmoil in Canada because of that term. And we're already starting to see people who have to renew their mortgages. They can't qualify at the higher rate. They don't make the stress testing limits. And so what's happening is now the market's getting flooded, and it's even happening locally in Powell River. I've seen it in Vancouver. It's happening. It was actually on Global BC News. We were watching this morning, and they're talking about rental inventories are going up. I'm just trying to think, when you're doing your due diligence and looking at the next deal for you, terms you mentioned, not just price, but terms. What kind of terms do you mean?
I'll use an example. Like we've been bouncing in and out of contract on a property right now. At first, we were going towards traditional finance. So we have a refinance where we're going to pull from for our down payment, and then we were going to finance the rest. Well, some circumstances changed. We're in an insurance claim on the one property, and so we're kind of stuck on it. So like that should just give a nice segue into like, hey, I'm sorry, but like my situation has changed. Now, like if I'm now doing this based on 100% loan to value, I need to make these numbers a little bit better and pitch them on seller financing. So that's the one I'm recently working on, because if I can like, you can buy down the rate, you can offer, an extra $50,000-$60,000. Like in return, I need a 3% interest rate to pay 2022 prices. I need 2022 interest rates. So it's like a good way that like commercial sellers to, you have to kind of look at each situation. Like you kind of have to do due diligence on the property and kind of like suss out the person on what their situation is. Is this thing leveraged 80% loan to value? Because in that case, no, they can't do anything because it has to be loan free afterwards. So yeah, it's like a good way to like try to bridge the in between. So that's kind of what we use is like the last property that we just bought, we submitted three offers: traditional finance, a blend, and then seller finance. And we'd give different prices, incremented up to like an extra $60,000 if they wanted to seller finance at a cheap rate. And we ended up negotiating into the middle with it.
So you presented 3 offers at the same time.
Yeah. That's
interesting. I don't know if we've ever done that. It's more, we throw an offer out and then we'll have a conversation of finding where the deal breakers are. You're doing sort of everything, going, okay, what looks the best to you? We kind of do it the opposite way. Just different. I really like hearing that. That's really unique. Very cool.
People aren't used to it here. Like we did, we were just doing another property that we were offering on. We had my buddies, a partner of ours, offering with their realtor because they were in-house, the same brokerage. So like, okay, present this offer. And we gave that person multiple offers, and they were, what do we do with this? Do I submit this one, then this one? I'm like, no, same time.
Submit them all.
Like, yeah, like you have to go in and present it and be like, here's your options, because like some people are dealing with a significant capital gain. So maybe they're actually interested in doing a 10-year term, aggressive principal. Like if I can max out and pay principal aggressively, then that works good for them because they can like pace it out, or just pace it back 5 years. And they're like, hey, in 5 years, I'm going to make a low income year purposely if they're a self-employed person. And then that way their capital gains can be less on that year that they actually took the money.
Very cool. Oh, I like it. Isn't that funny? So that you offer multiple offers at the same time, sort of snowball the realtor, right? I'm sure you did.
Yeah.
And
you get their attention for sure.
Oh yeah, of course you figure out what they want really quickly, and then likely do a variation of something for that, and then you finally get to a counter of one of those deals, or one of those offers. That's really cool. Good for you. What are you working? Go ahead.
So what I really like about it is like you're being able to be in negotiation with a bank, which normally we don't get to. We shop it around and you get what you can get. Where when you're doing it like this way, like with multiples, like they're getting to see the difference between interest rate and price, what the correlation of the difference is. And so when they kind of come to like wanting to work with you, like the last deal we just closed, they came back at a higher interest rate, which was a fair rate, but not at the price that they're wanting, because we were paying probably over a market value for right now. Not by much, but like enough that I was still comfortable. And I'm like, well, it's nice because when it's a holistically in the same circle, it's like, well, I want to make this work, but look at the numbers. And I actually, I'm very easy to deal with. I just show everyone everything, all my cards.
Sure.
I'm like, look,
that's the way you got to do it.
The numbers don't land. this doesn't work. I need the rate lower so
Hmm.
that I can do it. Or I need that unit vacant. Or like there's so many options when it comes to this. So when you do multiple, it opens up the conversation. And often you can just find a middle ground that works. Like how much down do you actually need? And okay, if you do 80% at a 3%, then I can finance that additional hard money at 7 and it blends. And, you know, that's how we were able to do that last one. And the one that we're working on, that I was on a conversation today pitching the vendor, you know, same idea. I actually didn't even talk interest rates yet. I'm just
Oh.
talking cash flow. I'm like, what can it do? What leases are, this is for a commercial property, like
Hmm.
not residential, commercial. And it's like, well, these leases are locked. So those are my firm cash flow numbers. I can't play with these.
Right.
So we have to make the numbers work within this. And that might land it at 3%. And then I should have a basis to work on that. Because they can see,
So,
they own the property. They know. They're like, oh, yeah, that doesn't work.
they're entrepreneurs too, right? They're in
Yeah.
real estate too. So, they speak the same language, which is really cool. But am I correct? Is this your first like commercial, like non-residential
Yeah.
um, investment? So you've shifted lanes now a bit because you still have your residential portfolio.
There's been very little opportunity in our market for commercials that have actually like piqued my interest. We've offered on them periodically over the years,
Hmm.
and I don't know why exactly, but the cap rate basis on it was never enough to ever make numbers land. It seemed like
Gotcha.
they were kind of basing it on, you know, a 4.5 to 5% cap rate, like quite
Sure.
aggressively, which just, and maybe that's because you have more power to be able to get people out because you're not dealing with the residential tenancy board here in BC. So you can actually, it's contract law. So someone's on month to month, you can raise it as much as you can before they say, now I'm out.
Right. Market
So
rate.
I think that's kind of the difference with it, though it's not easy when it comes to commercial. Like the one that we're been offering on has a very large space. Like it's
Mm,
massive, like 6,000 square feet now, a single unit. And I'm like, who's going to want that?
right.
Like very hard to find tenant. So definitely some more volatility. This one's mostly self-storage direction, which is very good. It's kind of for me like residential. I feel for the projected time horizon, I feel safe in that asset class.
Hmm.
Where if it was all heavy commercial, I don't know if I'd be as keen. Definitely my numbers would be more conservative.
It's amazing to hear you talk, Kyle, because I just know folks in your generation, a lot of them don't think the way you do. Where did you learn about cash flow? Where did you learn about how money works? Because so few people in your generation, I find, don't necessarily have the background of that. I mean, I don't know if the high schools teach it or don't. Maybe they do a little bit about budgeting for an apartment, but where did all that come from for you?
Um, it really is like that's the thing. Actually, that going back to our last episode that we had, like that's
Yeah.
really what I felt like was like part of it. Like my first commercial property, I think I did kind of speak of it. I was looking for a duplex. I didn't even think of the possibility of like going further than that. But then the numbers landed, and loan like I had no idea that it was going to be a whole different world. When I'm
Yeah.
like, what's an environmental?
Right.
ES1, like I'm like, I have no idea what this even means. And
Yeah.
like a commercial appraisal, I'm like, oh yeah, $400 for appraisal,
No.
$3,000 please.
Yeah.
And I need to go into every single unit and look everything over. I'm like, what is this? Totally
It's
different
a very
world. But
different
like,
game.
but if you have a good loan officer, I think that's actually quite important too. A lot of a good realtor is very, very helpful, but in commercial, depending where you are, it's hard to find someone that's done much of it. We bought our first one off market, so we didn't have that. But a good loan officer that walked us through it, and without him, we would have, well, we went to land financing, and he wouldn't have got his job. So he will walk you through it and figure it out with you.
For sure. For sure.
He worked with our lawyer for creating the corp and everything. Like it all makes sense. It's all laid out. Nothing's new under the sun. Like this isn't, you just have to, pay the right people to help you and be part of your team then and put the deal together. And cash flow learning just comes from then doing it.
Then doing it.
Once you get the first one under your belt, you're going to figure out that, hey, I can't just spend 30 grand on a fence because I want a fence. Like it doesn't work. You won't recover because our incomes, like we're all like my wife and I both were like kind of just small income, but consistently. So everything for us is based cash flow. So you have to be like super consistent and slowly working forwards, not just like these big blow up things.
Definitely time. I've found that time is really a big deal, trying to get the time working to help save save money for what you want, right? If you want a new fence, you can have a new fence, but you can't have it today. And so I find that's really the time aspect is really critical, especially when you're talking about lending. Love that your loan officer was so instrumental in getting the lending. And quite frankly, I haven't added a loan officer as one of the advisors in the podcast as I'm talking about that, but absolutely, seriously, I mean, that's actually a really good advisor, and hadn't really thought about it. I use banker, insurance agent. I'm just trying to think of some of the other ones. But let me ask you a question about the different lending institutions when you're going in traditional lending. So you've got your credit unions, which are basically a nonprofit financial institution that give back to the community. And then you've got your banking institutions, which are for profit. Have you worked with both of those or just one?
Both of them. I have done all three, I would say. The seller financing on multiple deals, and then I've done credit union. I hold a couple of mortgages with a local Victoria credit union. That was during that time. Again, it's all based on the loan officer. I had a really awesome guy at that time, and he was keen. He really liked Powell River and was pushing. And then for big banks, I've worked with, well, we have the big five, and I've worked with two of the big fives. Only on the residential side, though. They are, I was working on a portfolio type loan, which is an interesting caveat to once you get commercial, you can start looking at portfolio lending this was through RBC, through the commercial department. And that was very different again, working with them. I ended up not going that direction because of another conversation we can have another time about portfolio architecture, about how you're going to decide to stagger your loans and your properties and become stabilized. So I ended up not wanting to go that direction because putting all my eggs in that basket, for me, I said it's not my way.
Gotcha. For my US listeners, the big five banks, Canada has 5 national banks, and they don't do state or regional banks. They do just national banks. And so there's 5 big banks, and RBC is Royal Bank of Canada. And those are, we've actually seen RBC locations in like the Bahamas, Jamaica. And so they're all over. HSBC is another one. They're all in the Orient as well. So just I want to give some context to the US listeners that don't necessarily have that. They don't speak about the big five like we do in Canada, but that's really interesting. Do you see any difference between loan officers for a credit union or for any of the banks, or is it individually based, you think?
When it comes, let's use like a duplex type property. So like a residential 2-unit, personally held, kind of a simple one that, you can shop around to a lot of the institutions that all qualify. I found that their underwriting based on your income, if you go to each of the banks themselves, they're going to use the same rules. The ways that you can start to get more out of it, I found was like, for instance, I've used TD, which is one of the big five, but they
Sure.
do gross ups because as a self-employed person, my income isn't as high as if I was just working. Like if I'm a plumber, self-employed compared to working for somebody, in the end, my
Sure.
like T4 income would actually be higher, and I'd get to loan more. And RBC, Scotiabank, all of them are going to eat that up. They love it. And self-employed, I'm like, well, I'm making more money. Like it's evident, I'm making more money as self-employed as a plumber comparatively to working for somebody, but my numbers are lower. So they'll actually use your numbers and do a gross up, allowing you to use basic. I don't know how the back end works of it, but it bumps up your income.
Okay.
So that's only certain banks will do gross ups. Um, some of the credit unions sometimes will, but that's kind of, credit unions are cool because they're just a relationship based, basically.
Yeah.
That's why you'll find these guys that only use it, and they're getting like full blown preferential rates. They're getting underwriting totally differently. And for me, I've always kind of tried to start to go to a credit union because I'd like to have that relationship, and I've seen the power in that relationship. But I've always struggled with the rates. In the end,
Yeah.
a credit union is not as competitive on rates. And, like I'm doing a refinance right now, and, I'm at a 6.7 with a credit union,
Mhm.
commercial lending, 6.7, and said that they have a little bit of wiggle. They like the size. It's like the over 2 million range, which is, there's like, we don't talk about this, but in Canada, like there's actually like different points where rates can get better. It basically goes like, it's like something like over 100,000, over 2 million, over 50 million are like these lines where you can get better lending.
The thresholds. Yeah.
The
Okay.
threshold. So it was over that number. So they were keen, they were going to discount a rate a bit. And so it's still in the sixes. And then now I'm working with a new broker actually, because my broker retired down in Victoria. I was like, no, I need you. But anyways, I'm
Yeah.
working with someone that specializes, and this is a big thing for Canada. This doesn't pertain necessarily to, well, it does. I think the US has their own version, but CMHC lending, which is
Yep.
commercial insured lending in
Yep.
Canada. So you kind of have to work with a specialty broker for that. But my rate is looking like it's going to be in the high fours, about 4.8.
Wow.
So,
Wow.
and then there's these
That's
other parts of
great.
it, and they like to push their amortization. They're going to amortize
Mm.
over 40 to 50, depending on the study of the property. They're going to look at
Mhm.
the life expectancy. On my last appraisal, I think everything on my property was still over 50 for its depreciated like life expectancy. Some were a little bit lower, so some of those things I'll have to fix beforehand for them
Sure.
to want to underwrite on it. So in the end,
Wow.
I end up kind of going back to the big, and I think no, credit unions lend using CMHC as well, I believe.
Hmm.
But it's kind of like a whole different tangent of it. Totally different loan
Yeah.
officers, totally different terms.
Yep.
There's other weird things like the point systems where you can do efficiency or affordability. So you can do commitments for either of those. And that buys down your insurance, because just like CMHC for a first time home buyer, where you pay that, like, I think it's 1%, right?
Hmm. Hmm.
You pay that 1%. Well, when it comes to this, you can choose whether you make affordability commitments or you're going to make efficiency, and it's a point system. You can do a blend of them both, or
Sure.
you could just not, and you just pay a higher premium. I believe it's anywhere between 3 and 4%, which is no
Yeah.
small number to look at. But if you're locking in a 40 to 50 year amortization, these numbers long term, and that's for us. It's always like in our investing, it's a long term. You don't get, like, real estate, you don't get rich quick. You get rich for sure. And the only thing that's going to be there is,
Ooh,
like, the
I
thing you
like
need,
that.
you just need time. So for us, we're looking at, okay, is this, this insurance premium's like $70,000 or more. But in the long term, if we can lock in and stay within that insurance policy that lands on the property, our rate's bought down. I think it takes for us 5 years. It pays itself off in 5 years. So it's actually not that long that we start adding
It's
the
over in a
interest you pay.
blank.
Yeah.
Yeah, no, it's over in a blank. 5 years is over in a blank in real estate. I love that you've got some creative lending with CMHC, and for my US listeners, that's very comparable to FHA or Fannie Mae, Freddie Mac, any of those. It's still federally backed for US veterans like me. That's a VA loan as well, which the VA backs a lending institution. It's the same thing that Kyle's talking about regarding the CMHC. But it sounds like CMHC is actually utilizing, they do a ton of research, Kyle. I don't know if you're on their mailing list or not, but the CMHC does housing researches. They do for national, then they do metropolitans, and then they do provincial. And then, of course, each province does their own research. And what ends up happening is they're basically helping people like you and me because they're lower rates and they're amortizing longer, meaning the cash flow works, which goes back to your first point, is that if the deal doesn't work for cash flow, the deal doesn't work. You can't go broke trying to buy property. It doesn't work like that. So, well, what other things should the listeners be aware of finishing out 2024 and 2025 before my computer dies?
What else should we be aware? One
other
of the
tools.
things,
Go ahead.
one of the things that I would say too, and I think anyone in our regional area, at least for like coastal British Columbia, for Canada,
Sure.
or in Canada and at all, for us, we have toyed around a little bit with short term. And that's one thing that, like, if you start listening to podcasts, other ones like on different, I won't say which ones, but they'll talk lots about how to cash flow, like projections using short term. But we are currently in a government situation where the gun's pointed at it and stability is lacking there.
On both
so
sides of the border, that's happening. Yep.
Yeah. And it's tough. And I'm, fortunately for me, I've always been in the case of wanting long-term. I wasn't, long-term rentals is just the most stable. And so that's the direction I've gone. But like, I would be very conservative with underwriting. Because I think during COVID, I would underwrite things based on a midterm, maybe even a short term, because that option was there.
Sure.
And now I would not be doing that. I think as a rule of thumb, whether you plan on doing it or not, you need to make sure that it can pay the bills and keep the lights on as a long-term rental, which depending on which demographic you're doing, if you're doing luxury, if you're doing the one bedrooms, whether you're A, B, C, D, what class you are, there's, the price points are squeezed and not squeezed in different points. So doing your underwriting appropriately with conservative numbers, I think, is just super important. And that goes back to the thing of, like, again, negotiating. It doesn't mean that you can't do deals. It just means that you might have to offer more times. So get an agent, or do it whether you're doing it off market or on market, and just write more offers. My wife is an agent, and she tells everyone that I'm her worst client, because she is writing deals every single week. And, because that's how you have to do it. You have to be just putting out the feelers, seeing where they're at, because in the end, the numbers just have to work. And I think that's an important thing. Write more offers.
It all comes down to the numbers. Don't fall in love with the property, fall in love with the numbers. That's the way you got to do it, especially when you've got very weird interest rate stuff going on. You've got different programs. There's an election on both sides of the border. There's an election this year. I mean, there's all kinds of things happening. That's just, North America is just really, really unpredictable right now. You mentioned about podcasts. If you were to give a couple of different podcasts, the listeners are in the podcast world, what podcast would you recommend they listen to, other than this one?
The two on the top of my list for Spotify is yours, and I also listen to the Bigger Pockets real estate one. the money one is also good, but I find the real estate one, and if you are like me and I listen every day, they put out consistent content. It's amazing how much they put out. Well, they got a team.
Yeah, they've got a team. Wonderful.
Yeah.
That's a good one. Yeah, Bigger Pockets, Brandon Turner. He brings it. He's on Maui. He literally was right across the way from where we built Paradise Ridge, which is really ironic.
Oh, that's
Two, I would
interesting.
recommend. Yeah, really. And Mike's actually talked to Brandon several times. But two podcasts I would recommend. And this is they're US based, but they don't, they're applicable, is Live Off Rents. And the other one is the Real Estate Reserve podcast. And actually, I got interviewed on Real Estate Reserve podcast yesterday, and they purposefully don't want gurus who are driving Lambos and, they make it all big and sexy. They don't want that. They want folks that are still doing deals and all that. In fact, I'm talking about this thinking they should have you on, Kyle. You'd be a great guest for them. Yeah, they're based in Maryland and Pennsylvania, but they are just absolutely, in the trenches guys. And they also do self-storage. So they do multifamily and they do self-storage. And we were comparing books, but I'm glad that we had some references for podcasts. So thank you for that. Before we close out the show, I just want to say thank you again. And I would love to take you up on having you on.
Oh no. Thanks for having me.